Good evening and welcome to today's RTMA, which is a combined version of fundamental and technical analysis for November 27th, 2023. We begin with a disclaimer: suggested entry and exit points are only suggestions based on available information, which is both time sensitive and for educational purposes only. Right, let's look at the breaking news. And you see from the screen holiday sales. 953.57 to 966.6 billion is expected over the Black Friday Christmas season, and it's just a huge amount of money that is being spent on this jolly happy holiday season. All right, so almost $1 trillion in sales. Right, I would like you to make sure that you check out the blog. You have lots of information there, and if you're not checking it out, you are losing out. Beginning with the U.S. interest rates, the Federal Reserve kept the target range for the federal funds rate at its 22-year high at 5.25% to 5.5% for a second consecutive time in November, reflecting policymakers' dual focus on returning inflation to 2% target while avoiding excessive monetary tightening. FOMC had not discussed any rate cuts yet, while the primary focus remains on whether the central bank will indeed implement additional rate hikes. That's the challenge. And you can see in April 2022, all the way from almost zero to close to 6%. That's the major challenge. Additional interest rate hikes is the concern here. Even we saw almost $1 trillion in sales, that will contribute to inflation, some form, and so that may be a challenge. U.S. manufacturing PMI, the S&P global U.S. manufacturing PMI fell to 49.4% in November from 50 in October, below forecasts of 49.8% preliminary estimates showed. The reading pointed to the biggest decline in operating conditions at the manufacturing firms in the 3 months and restarted the period of contraction since seen for much of the past year. Businesses continue to run down their stocks of purchases and finished items amid improvements in supply chains, relatively subdued demand conditions, and efforts to cut costs. Weak demand for inputs were reflected in further concentration in purchasing activity, and manufacturers continue to report an improvement in vendor performance. So the decline here is suggesting that it's not a robust economy, but also at the same time suggesting there's no tremendous crash as previously experienced in those time frames. So it's a slight drop, telling us that while there's a challenge in the economy, manufacturing side is just mildly declining. The U.S. services PMI increased to 50.8 from 50.6 in October, the highest in 4 months, and above market expectation of 50.4, driven by companies reporting growth in customer bases following successful marketing campaigns. New businesses expanded for the first time in 4 months. However, employment moved into contractionary territory, indicating the first decline in headcount. So that although the services have slightly improved, 50.8 from 50.6, that's a good positive trend, but the unemployment is a bit of a challenge. U.S. Michigan consumer sentiment. The University of Michigan consumer sentiment for the U.S. was revised sharply higher at 61.3% in November from a preliminary 60.4%, but remained at the lowest level since May. It is the fourth consecutive decline in consumer sentiment as more favorable current assessments and expectations of personal finances were offset by notable deterioration in expected business conditions. Inflation expectations for the year ahead increased more than expected to 4.5% from the initial estimates of 4.4% and reached the highest since April. Expectations for the 5-year outlook was confirmed at 3.2%, a level not seen since 2011 March. So there you go. The sentiment has declined. I'm sorry, it increased from a decline from a month ago, but still below 63.8%, 68.1% in that time frame. So that's not a very good sign, but at the same time, it's not a disaster. It's a marginal decline, showing that it did get to 61 in November from 60.4 in May. Right, so that is a positive news, somewhat flat, really, if you think about it. Canada consumer confidence, this was the only report that was available in November. The consumer confidence increased to 47.26 from 45, averaging 52.2 from 2010 to 2023, reaching a high of 57, whatever. So that is a positive sign that consumers are confident in expanding, and that really takes care of retail sales, hopefully housing as well. The Canadian dollar, and you can see it closed at 136, making it over 1 month high. I mean, it's U.S. economic indicators putting the cooling inflation and job creation, signaling a weaker economy. And domestically, inflation in Canada fell more than expected, 3.1%, softer than the forecast, the Bank of Canada forecast of 3.5%. The reading signaled disinflation, which coupled with retail sales rebounding September and surpassing estimates. So what does this mean? This means the Canadian dollar is kind of dancing a little against the US dollar, and so nothing much has changed. It came down from almost 139 to 136, but well below the 131. How does that impact you? Every time you cross the border or you import stuff from the US, you pay 30%, 36% premium. The China loan prime rate, the People's Bank of China, PBOC, maintained lending rates at the November fixing as widely expected. The 1-year loan prime rate, which is a medium-term lending facility used for corporate and household loans, was left unchanged at a record low of 3.4%, and a 5-year rate was 4.2%. Monday's decision came after central bank last week held medium-term interest rate back steady as economic activity in October was mixed with headwinds from the property sector deepening despite slew of stimulus measures from authorities. Meanwhile, a weakening of the yuan continues to limit the scope of monetary easing. So this is a sign where all the other central banks around the world are increasing interest rates to meet inflation targets. China is reducing its prime lending rate, suggesting there's a strong economic challenge for the country. So China is struggling, particularly in the property sector. There is a problem with this mindset in China that when they buy new property, they would not rent it out because the perception is that if they rent it out, the value drops. So it's kept brand new. It's like some people who buy a car and keep the plastic wrappings on the seats for years. I don't know, but that's the mindset, and that's causing problems. Germany manufacturing PMI increased to 42.3%, the highest in 6 months slightly better than the forecast of 41.2. Still, reading continues to point to a deep contraction in the manufacturing sector, although the rate of decline softened. Now, anything below 50 is bad, and here you have 42.3. Outstanding businesses continue to fall, where signs of space capacity among goods producers reflected in the biggest job loss in over the last 3 years. Factory gate prices fell the least in 5 months, while purchasing costs posted the steepest fall in August. Finally, expectations among manufacturers improved but remained optimistic. Although it increased, it's still way short of the 46 targets in January. So not very good, but not bad as well. So it's like a kind of flat situation in the German manufacturing PMI. From the German services PMI, you see it rose to 48.7%, surpassing market expectations of 48.5, while the market marks the third contraction in the past 4 months. The decline was modest and slower than the previous month. Total new work inflows softened, reductions and staffing levels in the service stabilized after marginal decreases in the preceding 2 years. On the pricing front, there was a slightly faster increase in service sector output prices and a sharp accelerated price rise in service sector operating expenses, the quickest in 5 months. Looking ahead, service firms express slightly less optimism about the year ahead outlook. So that's really, again, a slight improvement, but overall shy of the April targets of 56 above, 57 around that has come down pretty strong. But again, bad, but not so bad, because 48 is a little shy of the 50, which was achieved not very long ago. So again, indication that it's flat in the economy. German consumer confidence fell for the third consecutive months to negative 28.1% from November 2023, and lowest reading in 7 months, and compared to a forecast of minus 26. The forecast was minus 26.6, but it actually was 28. The decline in consumer sentiment was mainly due to rising food, energy prices are weakening the purchasing power of private households, coupled with renewed increase in consumers' propensity to save to 8.5%, the highest level in over a decade from 8 in October. While the third decline in a row, hopes of a recovery in consumer sentiment before the year end must be buried for good. So that's where the consumer confidence in Germany, like Canada and the US and all of Europe, but basically food prices, energy prices are causing consumer frustration in the economy. The UK manufacturing PMI rose to 46.7%, up from 44.8. Output witnessed its lowest contraction in 5 months, yet inflows of new work and employment levels continued declining, primarily affected by unfavorable domestic economic conditions and sluggish demand. So that's, although a positive trend, still showing that manufacturing is still well below the 50, and so there is a growth, but not as good. It's kind of flat. Consumer confidence is pretty much the same, negative 24, and you can read this on your own. Basically, it's suggesting that improving consumer underlying numbers are still negative, and really the 5 components of expected not good, not great, slight improvement from minus 30 to minus 24, but still somewhat negative. Crude oil, WTI, crude futures dropped to $76 a barrel on Friday after facing heightened volatility in recent sessions, remaining under pressure as a dispute among OPEC Plus members over output quotas clouded the supply outlook. Oil prices tumbled nearly 5% on Wednesday before paring much of the losses after OPEC Plus rescheduled its policy meeting to the end of the month as disputes arose over output quotas for African members, including Angola and Nigeria. Before the delay, analysts were struggling that the group could extend or even deepen cuts to support market. Signs of robust supplies, particularly from non-OPEC companies, have also been weighing on crude oil prices. The U.S. government data showed that the crude oil inventories jumped 8.7 million barrels, way above the forecast of 1.16. So why did there be inventory high? Because of lack of manufacturing and transport and travel. So the $80 is the OPEC target, and sitting at 76 forces them to cut production. So, but then there is a challenge with the African nations, as we read before. Natural gas traded at 22.9 MMBTU after the EIA reported an unexpected decrease in inventories. Last week, U.S. utilities experienced a loss of 7 billion cubic gas storage, contrary to market expectations of 7 increase. This brought stockpiles to 3826 BCF, which remains higher than last year's level. Meteorologists forecasted colder than previously expected weather and anticipated higher heating demand for the next 2 weeks. Currently, record amounts of gas continue to flow to U.S. LNG export plants, additional support. So natural gas is, well, we haven't really experienced a massive cold winter yet, but it is anticipated that there will be a price jump, and not at 2.9, suddenly at least around 5, even 6, depending on the severity of the winter. So you have to look at gas producing stocks to take advantage of this. Heating oil, 284, 285 per gallon for the 2 weeks, high 292, touched in November 21st, tracking the decline of crude oil benchmarks after Saudi Arabia's dissatisfaction over OPEC's output levels drove the bloc to postpone its meeting. Pressure in heating oil benchmarks were also attributed to data pointing to mixed demand, as the latest report from EIA showed distillate products supplied were steady following last prior week's drop. Cushioning the pullback, the report also showed that revealed that the distillate stocks fell by sharper than expected 1.02 million barrels, while declining in heating oils accelerated to 179,000 barrels. A downturn was limited by lower capacity in East Coast oil refinery. So heating oil is a impact again of the weather, and that's showing some decline there. But again, like I said, we haven't had a severe winter storm yet. So gold steadied at 1,990 on Friday, hovering high near to its highest levels in 6 months, as investors continue to assess outlook for Federal Reserve monetary policies. Data on Wednesday showed that the number of Americans filing new claims for unemployment benefits fell more than expected last week, while U.S. inflation expectations for both the near and long term edged higher. The latest FOMC minutes also showed policymakers favored maintaining a restrictive monetary policy and gave no indication that the rates would fall soon. Markets still see Fed keeping rates unchanged in December, while traders scale back bets for rate cuts in March. Elsewhere, the ECB is likely done with rate hikes, and some investors expect the first rate cut in April next year. In China, the Public Bank of China left its 1 year and a half year loan prime rate at 3.45, which we saw recently. So China is the one that's tracking against rate cuts. So there is going to be no major rate cuts in the US and Europe. It seems that way, but like I said, they never get it right. They either over achieve or underachieve, and usually mess it up. So gold price is sitting at close to 2,000, seeing the events that take place. Copper edged 378 per pound, retreating from the 2-month high of 381. Pressured by a strong dollar as investors took profit ahead of the Thanksgiving break in the United States. In the meantime, a slight pullback in the Yashan copper premium suggested that manufacturers may have eased purchasing activity for recent years, potentially offering some respite for inventories after the latest data pointed to shrinking stocks. Inventories at the SHFE plunged by 45% from the corresponding weeks. Still, demand is expected to be sustained in China as Beijing pledged to target Chinese yuan 1 trillion in manufacturing and infrastructure development, lifting the outlook for copper. On top of that, experts stated that the Bank of China, Peking Bank of Canada, Peking Bank, Public Bank of China would inject 1 trillion yuan into the company's debt-ridden property developers. So copper has had a sort of quick run up, but well below the 4,200. Lumber roses to 540 per thousand, highest in 4 months due to a 2 to 3% decline in industrial supply caused by reduced production in North America. Factors such as sawmill operations cut back, lower annual allowable cut in British Columbia, and increased output costs led to supply constraints. Notably, Canfor Corporation closed its Polar sawmill for winter amid these challenges. Rise in also fueled by expectation of heightened housing demand in the U.S., supported by 1.9% month-over-month increase in housing starts to 1.375 million, above the expectation of 1.35. The trend aligns improved housing demand for 2024. So the lumber is expected to increase both because of the tremendous fires that took place, as well as demand for housing, as both the Canadian government and the U.S. governments try to bring in regulations to help housing starts. So technical analysis, we look at the North American charts. This is a 3-month chart. And here we see general an uptrend from October 30th. It has been moving, like we told you before. The market gets optimized, optimism rules as they come into Thanksgiving, Black Friday, good Christmas holidays, and New Year holidays, and so on and so forth. So all of them had moved up pretty decently, and you can see the S&P, the blue line, the New York Stock Exchange, which is the greenish line there, New York Stock Exchange. And then you have the Dow, which is the purple line, I believe, here. And then you have the NASDAQ. Okay, so that's just a general trend. Now, the TSX 3-month daily, and you see it just sits above the 20,000 mark, which is the break-even, kind of a break-even between the two blue lines. And you see between 19,500 and 20,500, 1,000-point range there. It's bouncing between that. It did break out to 19,000 in October. It's where there was a buying opportunities there, tremendous buying opportunities. And you can see the run-up since October 30th, from November the 1st, basically, in 30 days and 20-some odd days, you have a good run-up. It still is above 2,000. We expect that to remain. Now, the 10-day, 30-minute chart shows you, again, a downtrending in the RSI and stochastics ended marginally down on Friday, while stocks once again largely subdued as investors were reluctant to make significant moves due to lack of triggers. Retail sales in Canada jumped 0.6% in September, up from 2.7% from a year ago. Canada manufacturing sales fell by 2.7% from a month earlier. So there's still a nervousness in the market, and not really excited about things that are happening. So from the sector 6-month daily, and you can see the average flat trend here, still waiting for news to come out. But the two outliers here, the TTN, energy crude oil prices, and then you have TTMT, which is the metals and mining, which has come down 7.1%, whereas the energy jumped by 13.6%. The rest of it is kind of flat there and waiting for news to come out. See the banks and the TTFS, and then you can see here it is all flat here, waiting for earnings results of the banks, which are due shortly, and we'll see how that performs. Really, everything is positive. 3.7% was the BMO. The lowest and the highest will be the Royal Bank at 7.9% positive. So there's an upward trend on these things. Technical analysis, Royal Bank, 10-day, 30-minute chart. You see the next earnings is in November the 29th, which is this week at some time. So $5.27 is the dividend. It's at 118. It's bouncing between 118 there and 121. There's a $3 range. It is the RSI is flat here. The stochastic shows overbought. So it's a hold. So you want to hold it for your dividend play and then wait for the opportunities to get to 120 to 125. TD, pretty much, again, the earnings are coming out in December the 7th, $3.77 is the dividend. It's a tight range, a $2 range between support at $183 seems to be a support, but resistance at 85. So there's a $2 range. RSI and stochastics overbought and over flat. The energy companies and TTN, and you can see the TTN there, all flat here, tracking crude oil prices. The purple one being Enbridge at 7.07% up, and the lowest is negative 5 VET, which is 15% down. So it's really flat, bouncing along, waiting for crude oil prices to stabilize. WTI as Suncor, IMO, and Enbridge, and you can see this is a 1-year chart daily. It's closed at 75.54 was the crude oil prices. It's around 76. And you can see the black line, which is the oil price, and the IMO, which is the blue line, very, very close to what oil prices does. And then you have the purple, which is Enbridge and Suncor, which does tend to follow with the oil price, but not as close as the IMO. Okay, so it's important to recognize that while Suncor tracks oil, it doesn't flow as closely as IMO. So Enbridge dividend at 350, 46.57 was the close. That's really a 50 cents above the 46 mark, and below the 46 mark, 45.50 is the support, and the resistance at 46 right now. So it is it's flat right now. The stochastic shows oversold, but overbought. This one shows oversold, coming to oversold. So it's so it is waiting. It's in a waiting straight. You have to track oil prices and see how that performs. Suncor, $208, 44.65. It fell from 46.50 and 44, $2.50 range. It's flat. Nothing happening. Again, waiting on oil prices. IMO, $3 range, very, very tight. Remember here we showed you 1 month, it was 85 1 month ago, it was $85. And 3 months ago, it was still sitting at 85. It's sitting at almost $80, 78.90. And that's flat. So you want to keep an eye on IMO. The November 13th, we had RBA as a suggestion. We closed out at 82. We bought at $82, sold out at 84. I think it's trading. This is okay. It is trading above 85 right now. So we did take $2.50 profit. The earnings, and we said the banks are out. BNS, CM, Royal Bank, TD, and National Bank all out within the short time frame. The blog, you see the calendar that's been posted. It's important that you recognize or spend time looking at the events that are supposed to be out. You will pay a price if you're not tracking those things. Warning given. All right, that's about all we have for this session. We ask you to be patient. We look at the positive economic trends. It's not negative. It's kind of flat. You've seen fundamental analysis, the economies of Germany and China and UK and Canada and US are just flat. I mean, there's no excitement or no tremendous decline in the indicators, but caution is advised because of the retail sales. You see a $900 billion sales program in the Christmas season that is about to bring a challenge for inflation, which may cause interest rate hikes. Although it wouldn't be terrible, but there is already people in Vancouver and in Toronto walking away from housing commitments that they had made, that they can't fulfill the mortgage rates, and so they're walking away with losses. So that's a major challenge that needs to be addressed. And also, we'll have to wait and see how the elections that are coming up it could be in 2024 for Canada because of the pharmacare deal that was done between the NDP and the Liberals to keep the Liberal in power till 2025 may break if it is not resolved by the end of this year. And so the NDP may pull out its resources or its support for the Liberal, which will force an election, I think. So we'll see what goes on. Also in the South, you have to watch out. The election starts, activity begins in January in Ohio, I think. So that's another place to be of concern. Of course, the Israel-Hamas situation is still challenging. Some hostages have been released, some have not been. There is a continued attack on U.S. installations in the Middle East. There will be a repercussion somehow, somewhere in the Middle East that's going to happen. And we have to watch the Suez Canal and the Straits of Hormuz, because Iran and Russia are targeting potential exports of oil. And also you have Chinese ships out there, and crazy things are happening. On the other hand, we have to watch the Ukraine bogged down war with Russia, whether the U.S. will support Ukraine or will there be a ceasefire. We also keep an eye on China and its desires on Taiwan. So that's all we have for now.